Nick Elder with Ironton Capital, joined here by Lon Welsh, chairman and founder of Ironton Capital. I've got Joe Massey with Cassie and Cook, and I've got Stacy with Blue Federal Credit Union. Before we get started, quick note from our attorney. So in this presentation, you may see some forward-looking statements such as will, should, expect, plan, seek, believe, estimate, etc. This is not an offering of an investment opportunity. Please know investment in any fund involves a high degree of risk. And everything in here is confidential. So if you reach out to us and you want to learn more about Ironton Capital Funds, you're welcome to do so. But please keep in mind to always involve your CPA, financial advisor, tax attorney, whomever is involved in your decision-making process. It's very important that you coordinate with all of them as you make your investment decisions. And so that being said, I'll turn it over to you, Lon. Why don't you do an introduction of yourself here and of Brent and Richard, the investment team.
Yeah, so there's three of us on the investment committee at Ironton Capital, Brent, Richard, and I, and we've all been doing this, in Richard's case, over 10 years, and Brent and I over 20 years, and I have found that refinancing to take advantage of equity that we've developed in properties is one of the things that's had more impact on driving the rate of return I've had over the 20 years than anything else, so I'm really excited to have just that as a topic today. So I'm going to talk just real briefly about the incredible amount of appreciation and equity that it's created. And then Joe's going to talk a little bit about an analysis tool to figure out what your options might be with that equity, one of which might be to take out a second mortgage. And then Stacy's going to talk about how you can do a second mortgage with her team to unlock equity. And she actually recently helped me take out almost $250,000 from a duplex Airbnb. And it was a great process and really helped our returns a bunch. And then if we have time after that, I'll talk a little bit about Airbnb analysis, but I suspect that those first three things will keep us really busy tonight. So first off, I know a lot of our investors so far and a fair number of the prospects that we've got are people that have come to my different how to be a landlord classes over the last 20 some years. And a lot of you guys bought houses in the 2010 to 2015 range and have seen your home prices triple since then on your rental properties. So something that's very interesting is this is the average home price appreciation for each state since 1991. And the US average is just a hair under 300%. But the three best states are Montana, Utah, and Colorado. So if you've bought rental properties here, congratulations, you won the jackpot. So to give you a sense of what that means, let's pretend that you bought a rental house for $125,000 in 1991, which is when that chart started. And if you take a look at the blue line on the left, your $125,000 house grew to be worth about $700,000 during that time period. And that's that rate of return that on average, Colorado was able to realize. And you can compare that to the orange line. That's the overall US average. If you bought that $125,000 house in 91, it would have grown to just under 400,000. So still just tremendous. So what if you put $25,000 down or a 20% down payment back in 91? That would be a $25,000 down payment. Well, how did that equity perform for you over time? And you can see that the heavy blue line here on the right, your equity in your house grew from 25,000 to 620,000, which is an absolutely bonkers sort of number. That doesn't take into account that you would have paid off a lot of your loan on top of that. That's just the equity appreciation on your initial down payment. The green line is the stock and bond market, and the dashed line is the US overall home average. So if you've had real estate for a while, you're probably sitting on a lot of equity. So a question that you might ask is, does my return on equity get impacted over time as I build up more and more in the war chest and the value of my house? And I'm going to give it to Joe to tell me the answer to that.
Yeah. So the answer to that is your return on equity goes down, right? Because your equity generally is growing faster than your cash flow or growing faster than other income sources. So the return you're getting generally goes down. So that's why we put this together is there something better that you could be doing with this equity? So what we've got on the screen here is a spreadsheet that Lon and I worked on together to analyze what would happen if you do a cash out refinance. And so we're going to start on the left-hand side with the property information. And let's say you've got current equity of $250,000. And we're just going to go down this first section here. And your current property value is $475,000. And you estimate that properties are going to continue to go up at 5% a year. Now, this is up for debate. We know last year prices rose about 3%. We predict somewhere between 2 and 3% this coming year. But over the last 40 years in Colorado, homes have gone up an average of 6% per year. So we try to be conservative, and we said estimated annual appreciation of 5%. And you've got a loan on the property currently at $225,000. And your monthly payment, just principal and interest, is $1,432. And then your annual net operating income, this is all of your income minus all of your expenses, but not including the mortgage, right? So mortgage payment is separate. You're making $23,175 on that property, which after the mortgage payment comes out to monthly cash flow of $499 a month, or almost $500 a month, or $6,000 a year. And then your marginal tax rate, that's going to be important later, but we just selected a 32% marginal tax rate. Now, over on the right-hand side at the top of this page, what happens if you don't do anything, which is obviously reasonable. You've got an investment property, it's got equity, it's cash flowing, and you just say, hey, I just want to keep on keeping on. Well, over the next 5 years, the value at that 5% appreciation is going to go up to approximately $606,000. And your loan balance, because you're making your payments every month, your loan balance is decreasing to approximately $210,000. And then your 5-year cash flow is just under $30,000. So one thing we did not factor in here is any rental appreciation. You're most likely going to increase rents, but that's a little bit speculative in nature. So we said again, let's just assume nothing happens other than the value goes up and the loan balance goes down. So your total 5-year cash flow would be at just under $30,000. But you're also getting gains from appreciation, principal reduction, and depreciation, your tax benefits. That's an additional $167,000. So you add those two together and you get that underline there on the right-hand side of $197,000 that this property is going to earn you over the next 5 years. So your projected ROI in orange there is 15.8%. Now that's your pre-tax return on investment. And your after-tax projected return on investment is roughly 10.74. So that's if you don't do anything. So let me pause there. Lon, did I explain that well? Did I leave anything out?
I think it makes sense. Nick, did that carry okay to you?
Okay.
Yep.
So now let's move down to the next box on the left, and let's say we want to take cash out, right? We know we've got $250,000 of equity. We want that equity to be doing something else for us. Well, what could you do? So you could borrow up to 75% on a new cash out loan. And so that's going to be there 75%. You could get a $356,000 loan. And you're going to, of course, include some closing costs into the transaction. And interest rates, we all know, are up as compared to in the past. Let's just say 7.875. So your new principal and interest payment would be just over $2,000, $2,056. Your monthly cash flow is now negative. And so what we put in here is, what if you said, I don't want to take out that full $356,000. I just want to take out $50,000 and I want to put that into another place. Where could I put that? Well, if you were to put that into the Ironton fund, and we're going to go down to the next box here. If you put it into the midterm fund at 12% for 5 years, that's going to gain you roughly $38,000. And you're still going to be getting that same number of $167,000 for appreciation, principal reduction, and depreciation. However, you're going to be losing a little bit of money on your cash flow because your monthly payment went up. So that's that negative $7,400 there right in the middle. And so over on the far right side, you see your projected return on investment in that medium-term fund would be 15.9%. And then below that, 10.79%. So not a huge difference from doing nothing. And part of that is because your interest rate is probably going to increase. Well, what if you put it into the long-term fund? And that's the last line before the charts there. The long-term fund, we're projecting right around 18%. So your net gain from that $50,000 over 5 years would be roughly $64,000. Combined with your negative cash flow, your appreciation, principal reduction, and depreciation, you're going to be making roughly $224,000. So after tax, on the far right-hand side, you see roughly a 14.37 after-tax return, which is a 4% increase over what you would get if you did absolutely nothing. And then at the bottom, what you see are, it's difficult to see, but there's a green line, which is what would happen to your money if you were to put it into the long-term fund, and then a blue and an orange line. What would happen? The blue line is if you put it into the medium-term fund, and the orange line if you did nothing. Now you see those are pretty well correlated, the orange and the blue. That's why on the right-hand side, they're almost exactly one on top of the other. But the idea you want to think about here is maybe I want to put $50,000 into one or another of these funds, or maybe I want to do 100,000. And you'll see right above the graph on the left, your maximum that you could take out for a cash out transaction would actually be up to $120,000, or you can take out $105,000 if you wanted to do a home equity line of credit, which is why we've got Stacy here to talk about that. So let me pause here, Lon, and let me ask you, what would your preference be? Do nothing and continue to get a 10% after-tax return, or maybe make some changes, get some cash at a 14% return? If you're an investor, which one do you like better?
Well, the refinance is almost always going to be the answer. So that's actually what I just did with one of our Airbnbs. We had a lot of equity in it after we did the renovation, and Stacy was able to help us to refinance, or I'm sorry, not refinance, but put in a second mortgage, pull out a lot of capital from very similar terms, which you've outlined here, and then we've reinvested it, and it's going to be a good spread. This is basically what banks do. I mean, the banks will borrow money from consumers at 3 or 4%, lend it out at 6 or 7%, and they're making a spread of about 3 or 4%. And you can be a bank and do the same thing.
That's exactly right. That is exactly right. Did I explain this slide well? Does this make sense on an option for increasing your return on your equity?
Yeah. If any of you guys on the webinar have any questions, just pop them into that chat box there, and we'll try to answer it as we go.
So now let's go to the next slide here. And what if we wanted to do a home equity line of credit? So everything at the top is still exactly the same. If we don't do anything, we're going to have that 10.7% return on the far right. But now in the next box on the left, if we were to do a home equity line of credit, and we can take out up to 70% and invest that into Ironton. Now you're going to see a home equity line of credit interest rate. It's going to be variable. You're going to be getting that cash out at a slightly higher interest rate, but you're going to be maintaining likely a lower interest rate on your first mortgage. So what does that do for you? In this case, you could take $50,000 cash out of the property. You're still going to have positive cash flow of roughly $138 a month. Following along to the far right, you could put that money into the medium-term fund or the long-term fund, and now be making after-tax between 11.6 and 15.37. And that's represented on the graphs down below. You see now the blue line and the green line are getting a little bit better because it's a little bit more preferential financing on getting a home equity line of credit versus taking all of that and rolling it up into a higher, more expensive fixed rate interest loan. That makes sense, guys?
Yeah.
Now the third choice, and then I want to talk with you, Stacy, about doing the home equity line of credit. We definitely want to get you in on this. But what if you were to sell? And this is one, Nick and Lon, I think we run across this on a fairly regular basis, that somebody says, I've got a property that's got $250,000 of equity, and I'm just tired of it. I swear, I think the thing is haunted. It's always got problems. I have troubles with tenants. There's constantly maintenance issues. I had squirrels in the attic last month. It's just can become a hassle, right?
You're describing my rental.
So what happens, again, at the very top, if you do nothing, you see you're getting about a 10.7% return. Well, what if you sell this property? And so we've got a couple of more pieces of analysis here on the left. Your original purchase price and the original date that you purchased the property. Now, when you sell the property, you're going to have some costs. Number one, there's probably going to be some depreciation recapture. There's going to be costs to sell the transaction. If you've got a buyer's agent and a listing agent, there's some other costs associated with it. There's title insurance, the final water bill, things like that. And would you have to pay any capital gains? And oftentimes the answer to that is yes, but of course, consult your CPA. But if you were to sell this property, you would now have $186,000. And what happens if you were to invest that into Ironton Capital? Well, what you see here is to compare this. We wanted to put down here on the right, if you were to put that same amount into the medium-term fund or into the long-term fund, your after-tax return is now 8% or 14.4%. Whereas up above, for keeping the property, you're going to be right around 10%. So when you look on the bottom right and the bottom left-hand charts, you see that your money starts out a little bit less. All right. And the reason is that is the cost of doing the transaction. That's the cost of selling the property, paying capital gains tax, paying commissions, etc. But if you look on the bottom right, that green line begins to grow really, really rapidly as compared to doing nothing. So I think it's a good thought if you have a property that just is not working in your portfolio. Yes, there's going to be some costs to selling it, but over a 10-year horizon, you're going to be making a heck of a lot more money versus keeping that. And arguably, there's not going to be too many hassles, right? I don't think you guys have a lot of squirrels that we have to deal with in the attic of your properties that you call me on, right, Lon?
Right.
So let me pause there, guys. Did I explain this well? Any questions?
I thought it was pretty great.
No, it's
This
a
is
great
coming
explanation.
up on the question box there.
So Stacy, let's bring you in here. Let's talk a little bit about the home equity line of credit. You know, this is really your area of expertise. Break it down for us. How does it work? If I've got an investment property, how can I do that? What can I take out? How much cash can I take out? How does it work?
Wonderful. No, thank you. Appreciate the opportunity to share a little bit around that. So Lon, I have some good news. I know, I think you and Joe mentioned 75%. Typically, we can actually do 80% on residential real estate when it comes to investment properties. So a little bit more of a stretch. It's great. And you also mentioned Montana, Utah, and Colorado. Those are all footprint states that Blue actually lends in when it comes to investor properties. So some good news, especially for those joining us from kind of the surrounding markets. With home equities, couple things to consider and ask yourself. Do you have a schedule of real estate owned? Best thing to do is track it, whether it's somebody else's form or your own. Make sure to have a spreadsheet. Know what your property is, current outstanding debt, as well as value, and then the cash flow on it as well. What's your payment? And then what is your monthly rental income as well as expenses? We will add back different expenses you have for your property. So part of the model with Ironton is capitalizing on the depreciation factor of that. We actually add back depreciation and interest expense into the cash flow for the property when calculating those home equities. Now, from a cost perspective and from obtaining these things, two things to look at. How is it vested? Is it vested in an LLC, potentially an S corporation, something along those lines, or is it in your name individually? It's going to be cheaper if it is in your name individually. You can do typically a standard home equity line of credit through a normal institution. Again, about 80%, 75 in some places, but Blue will actually do 80 on investor properties. And typically there's a cap, usually about $200,000, $400,000, $500,000 or so, or usually it's a unit number for a cap for home equities in the consumer space. In those cases, you're paying title and value on it, but usually nothing else. And rates are probably in about the prime rate range, prime plus a half or so. If you wanted to look at borrowing under your LLC, so if you own multiple rental properties, like the extra protection of having an LLC to shield you from potential liability when it comes to your tenants, you can actually borrow in the LLC name. This takes it off your credit bureau from a reporting standpoint. And Joe will tell you, Joe, how many borrowers do you get that have a list of 8, 9, 10 properties or mortgages on their credit bureau?
A lot.
Quite a few. And usually there's a cap sometimes of how many somebody can have. So if you need to streamline it so Joe can help with the acquisition of more, or you want to make sure it's not reporting personally, you can borrow in an LLC name and still have a second lien home equity. You don't have to touch that first mortgage that you might be at a fantastic rate. So if you are borrowing in your LLC name, one thing to make sure you do have a business operating agreement. Who can borrow, who can pledge the property? That's something that's key there. We will look at how the cash flow looks for you personally for the property and then globally as well. So rule of thumb is for every dollar in debt you have on your business and your personal income combined, you want $1.40 in income. So add up all of your income that you have in your household, add up all the extra income you have for your property. We want about $1.40, so an extra 40 cents above and beyond that debt that you have to carry for it. So I'll pause there because I know that can be quite a bit of information to look at, but anything else come to mind as far as what we should explain further?
We have a question. I've got a question myself, but I want to address Michael's question here first. Lon, Michael's asking, how does Ironton get an 18% return?
So our National Diversified Fund, that's our target, is to be in the 17 to 20% annual return range, and we'd be happy to send you a link for a webinar we did on that, as well as the PDF that explains it all. So yeah, we'd be happy to share that with you.
Stacy, question I have, we have 8.5% here for the HELOC interest rate. What is the range that you see, and how does the leverage somebody would get influence the range of the interest rate that they would get on their HELOC?
Good point. Standard rate is for us is typically about prime plus 0. Prime is at 7% right now, I believe. Correct me if I'm wrong. I know we're all hoping it's going lower. Yeah. 7.5. Sorry. I know we're hoping it's going lower. And so roughly that range right now. Your traditional lenders that like to give themselves a little bit more margin will typically be pricing it at about prime plus 1 to prime plus 2. If you are paying that much, I would recommend revisiting it. Even if it's a current home equity you have on an investment property, if you're paying above prime, take a peek. You may have more equity or you may have a better rate, which will allow for better cash flow on your property. And how much we will consider leveraging the property for. Typically, we want to make sure that your property generates enough income to cover both the first mortgage payment and then the equity payment on there. So if it can cover at least both of those, that's our general rule of thumb for underwriting. And then we do want to see that there's just some extra personal income as well. So there's a little bit of extra discretionary personal income. The other thing I would throw out there is don't be afraid to just look at your rates in general. If you see that there's an opportunity to cash flow better by reducing your rates on car loans, or you've allocated expenses for these rental properties, have you put them on your personal credit card? Are there certain things where you could be utilizing it better so you can invest and receive a better return? Those are some things to just take a peek at in general. But rule of thumb about prime plus 0 in that space right now. And also pay attention to if you have annual fees on those lines of credit. And then the final piece I was just going to share around that space was just the documentation. Do be prepared. About 3 years of historical financials are what we look at to look at the business side of it. So just plan to have that information handy and available. And then from a sizing standpoint, if we can keep the lines at about $400,000 or less, we can look at streamlined ways of valuing the properties. If we want to lump everything together, have a little bit of a larger loan, then we'll go ahead and have some appraisals completed on those properties if we're going for a larger loan amount. But that's just a regulatory constraint we're stuck with. But we can also help strategically negotiate that.
Are you also seeing the prime plus 0 on primary residences with a little bit higher leverage?
We are. I'm biased. I spent 19 years in the banking world, and then I'm coming up on 4 in the credit union space. And credit unions are a little bit rainbows and kittens. The rates are better. And also prepayment penalties don't exist in a credit union space in most cases. So typically see prime or prime plus on the banking side. With credit unions, if you're currently a member of one, check with that credit union. Typically you're as low as prime minus a half on more primary and second homes. No annual fees in those spaces, no prepayments, and less of an origination expense to get into those as well. So small nuances, but it does add up depending on how many properties.
Great.
Fantastic.
So, Lon, I think we've got some examples here about your Airbnb that you recently worked with Stacy on. Do you want to talk to us about this?
Yeah, so a lot of you guys have had rental properties for a long time like I have. So I've done this analysis on my long-term rentals, and basically the math showed that for every one of them, it just made sense to sell them. So if you've got a long-term rental and you're not sure what rate of return you're getting anymore, Nick and I have got a very easy Excel sheet that will help you to analyze that. And then you can figure out, well, if I just kept my long-term rental for another 10 years, what would that mean? If I were to sell it and then say do the stock market or income fund or our long-term growth fund, what would that do for my family's wealth appreciation over the next decade? And then you'll have all the facts you need to make a really clear, informed business decision. So for the Airbnbs, they don't fit into this analysis framework well. So I did a couple of my Airbnbs. I'll just show you one of them here. So this is Bijou. This is in Colorado Springs, right outside of downtown. It's a turn of the century Victorian that was remodeled pretty well when I bought it, and I finished off the remodel. So it's kind of like a pottery barn sort of a place. And what I found is that the revenue, if you take a look in the upper left in 2020, wasn't too bad. I had a partial year in 2020. It was really great in 21, that COVID spike when everybody went on vacation. And my revenue's been declining ever since, which mirrors the overall industry performance for Airbnb. There's been a lot of new people putting their properties on Airbnb. So even though the demand on Airbnb is increasing, it's not increasing nearly as fast as the supply side is. So as a result, revenue for property has been going down for several years. The blue line's the actual, the red line's just sort of a forecast for the next couple of years. Meanwhile, my expenses have gone up a lot. And maybe you guys have seen this in some of your rental properties as well, that insurance has gone up quite a bit, as well as my taxes. And then just pretty much anything else involving labor hasn't been great. So if you go one more over to the right, you can see the cash flow after mortgage. You know, I had a couple of really great years with this duplex on Airbnb. And now I'm like at break even or just a little bit below. And when my mortgage rate reset last month, this is no longer very good for cash flow anymore. So you wouldn't be surprised if you look in the lower left at my annual return on equity that I had a huge spike during the post-COVID years. And now I'm like right about at zero. The amount that I'm losing on a cash flow basis, we are able to offset by the long-term appreciation on the property, but it's not generating an awful lot anymore. So most of my Airbnbs are following the same pattern. So for those of you guys who are curious, I put several different case studies in here. I won't go through them all, as it's mostly the same story. But you can see from an analysis standpoint how that shakes out. So if you've got an Airbnb and you're curious about, should I try to refinance to take out my equity or should I just sell it? Feel free to call Nick and I. We won't be able to do the same analysis that we do for the long-term rentals. We can give you a lot of ideas to help you think through the opportunities that you've got. In some cases, like for my one on the duplex on Perry Street, it made a ton of sense to have Stacy put in a second mortgage for me. In other cases, like this one on Bijou in Colorado Springs, it's just going to be time to sell this one pretty soon. So with that, I guess I'll just open it up to all of you guys for questions about how to unlock your equity and what you can do. I think Joe's tool is probably the tool that for a lot of you guys will be really, really powerful. And Joe, is that something that you can set up like a quick meeting with someone and walk them through it? Or what's the best way to interface with you on that?
Yeah, you can call me. I'll put my comments or put my contact info in the comments. Would love to have these conversations. We actually just helped somebody, gosh, about 2 months ago that they were able to take about $1 million out of a property and invest that with Ironton. And you know, their interest rate was, I want to say 6.875. And then they were able to invest that with Ironton. They put some in the medium-term fund, generating 12%, some into the long-term fund, generating hopefully 18%. And they're only borrowing at 6.875. So they're making a very good spread on their money. And it did not impact their cash flow at all. He's a business owner, has lots of cash flow coming in from the business. So he also gets a tax deduction on that money that he has now borrowed. So I would be happy to go through that analysis with anybody that's interested in that. And I'll put my comments or I'll put my contact info here in the comments.
Hey, Stacy, can you put your contact info in the comment section for everybody too, please?
Not a problem.
You know, Nick, you got all Stacy's info, right? So if someone calls you afterwards, you can get it to them?
Yep, I've got Stacy. I was about to text you, Stacy, actually, to confirm those rates one last time. I'll do that after. But
No, and I would just share, Nick, from a rate perspective too, don't be afraid to explore variable, but also fixed rate options. Fixed rate actually come in lower than that 7.5 range we were discussing. So,
interesting.
Yeah, feel free to look
how much?
at my options.
But how much on average could you fix that rate versus
Upper sixes for fixed rates.
Wow.
Second lien on an investment property are areas we can look at right now.
Wow. Okay.
That's great.
Now, is there a term to that fixed rate, or can you switch between variable and fixed? Can you be pretty flexible?
You can't switch between the two, but credit unions are known for being able to modify loans. So if you kind of break out that, take the blinders off the traditional mortgage you might be in on a 30-year product, you can modify business loans throughout time. So it's a nice cost savings if you don't have to move from place to place to place refinancing. The payment is typically fixed for anywhere from 5, 7 up to 15 years. And then the amortization for the payment is over 30 years. So we do want to restructure something by that point when your rate starts to adjust for however long it's fixed for. But the payment is still spread out to make it palatable and make that cash flow appealing for you as well, because I know you want to make sure you're maximizing that margin you're getting with the Ironton return and your cost of funds for it.
Yep. Guys, if you're even thinking just a little bit or wondering what the returns are in your portfolio and in your rental property, it's certainly worth having a conversation. We find so often with investors, especially those, and I'm sure, Lon, you can vouch for this. You've owned property since the early 2000s, I believe.
Yep.
You've got extremely high equity, and as a result, nearly no debt. As a result, your return on equity is likely pretty low on a lot of your properties, and I'm guessing that's why you refinanced a lot of them or got a second mortgage. So we find quite often, we'll have investors come to us. They'll look at their return on equity and they'll look at what can they get in cash flow, even in the medium-term income fund, and in many cases, their cash flow doubles, even sometimes triples, by selling or just by getting a line of credit and going into our income fund. So there's a lot of options out there, and we're doing this to show you guys that, hey, there are other options. And if your ROE is pretty low, you might be able to capitalize on even better performance just by taking some action here.
It's an unusual time where we've had, such a high rate of real estate appreciation in such a short amount of time. It's like a once in a generation gift. So if you are experiencing low return on equity, it's because you've won the jackpot on appreciation. So you've done nothing wrong. You've actually done everything right. So now it's just making a mid-course correction based on the bonanza that you received. Yeah. So if you need a portfolio review, it's just irontoncapital.com/review to set up a time with Nick or Ryan. We're happy to do that for you.
Yep.